welcome to Fountainhead, brought to you by WebEngage. Fountainhead is a consolidation of all of our education, ecosystem, and community efforts. As the first initiative under this umbrella, the Fountainhead Leadership Series aims to bring to you the best of industry leaders to share actionable insights, tricks of the trade, and to answer all of your nuanced questions. So ready to get inspired and entertained? Let's go.
Hey Abhiroop, good morning. Good morning, everyone. Hi. Good to have you, Abhiroop, today. So, guys, Abhiroop is the co-founder at Velocity, and he's been before this, he's been an investor at Elevation Cap as well as a founder at Taskbob. So he's been through multiple sides of the table. So, Abhiroop, if you can give us a quick, idea of your journey so far. How's it been across both sides of table?
Sure. No, absolutely, Nitya. Thanks for hosting me and excited to be here. So I started my career close to a decade back with McKinsey and Company as a management consultant, where I worked mostly in financial services. I was serving banks and private NBFCs in India. And that led to a very good understanding of banking in India. I left that to start my first company, which was Taskbob. We were aggregating local service providers. And we had started this in 2015, which were early days of this market, right? So we built it for 2 years. There I was leading a lot of our efforts across marketing, growth, and a bunch of business functions. I also learned a lot about digital marketing, burned my fingers there in multiple ways, and learned it the hard way. And when that didn't work out, I ended up joining SAIF Partners, which is now called Elevation Capital. At Elevation, I was backing financial services. I was investing primarily in fintech startups. And that led to a great understanding of everything new age which was happening in financial services. And then I was feeling the itch again to start up. And I saw the gap that, there is this big gap to capital even for like a new age company with transparent data and transparent cash flows. And to solve that gap is when we started Velocity in early 2020. So that has been close to a decade of journey for me, Nitya.
Interesting. And Abhiroop, let's zoom in a little and understand how did Velocity happen. Like you mentioned about the financing gap, right? New age companies, etc. So how did you sort of see this? Come up with this idea, etc. How did Velocity exactly happen? And your previous experiences, did they also lead you to sort of where you are, what you're building at Velocity?
No, absolutely, Nitya. I think it's a very clear joining the dots for me. So I think I saw that companies are raising capital, diluting their equity without really realizing that equity is actually very valuable and it's expensive to keep on diluting your equity to fund your business, right? Now you should use equity as a source of capital when you're taking a big risk, right? When you are unclear of what the outcomes could be, and hence it is worthwhile trying to raise that risk capital. But what I observed was that a lot of companies are raising capital for deploying that money in marketing and in inventory, right? And that was just a very expensive way to fund the basic working capital cycle of the business. And that's what led to the understanding that, why are they doing it? Why are they not really able to raise capital through non-dilutive means? And that's when I observed that there is this big wave of tech-first companies, digital-first companies being started in India, which is not well understood by banks on one hand, and VCs will probably fund a very few portion of them. And even that funding is not the right source of funding for most of their needs, right? So that was a big gap. And I figured that a lot of these companies are actually generating healthy revenues, which a third party can track through API integrations. And that's what led to the concept of revenue-based financing. That, if a company is generating revenues, which I as a third party can track and verify that, these are actually the revenues which the business is generating, then they should be able to get capital against that. That's the biggest asset which a company can have, which banks don't really know how to value. And that's what led to us starting Velocity. We were very clear that, we are going to be focused on the segment of new age businesses, because that's where the data is very transparently available. And I think it's been quite a ride. So over the course of last 2 years, we have built a portfolio of close to 300 companies in the e-commerce and D2C kind of space, which is bigger than any other VC's portfolio in the country, right? So we work with these companies across multiple cycles, and we keep on supporting their growth capital needs. So that has been the journey of building Velocity, Nitya.
Interesting, Abhiroop. So you're saying that basically you either raise a sort of a risk capital from a VC, right? If you're doing a moonshot bet, or otherwise
Right.
you have growth capital and these new options where you have
Yeah.
these alternative options. That's how that's how you would break down, and for founders as well. If you're planning to
Sure.
raise the kind of capital as well
So
available.
I can actually share a more comprehensive view on that. So it is
Mhm.
true that in case you are taking a moonshot bet, you need like heavy upfront investment, which may or may not pay out in the long term. Then it makes sense to try and raise equity capital for that. In case you need capital for your working capital needs, which are basically your inventory, your marketing spends, etc., everything which is a part of your direct costs, then
Mhm.
it is much better to raise revenue based financing through a platform like Velocity, because you get to retain control on the company, and you also
Mhm.
build that discipline of trying to raise capital and then paying it back over time and then raising again, etc. In case you need capital for capex, in case, for example, you need to invest money in plant and machinery, you're acquiring some assets, then banks will also provide you capital against that.
Yes.
Because banks do understand asset-based financing, that's a capability that they've built over multiple decades.
Yeah.
So, in case you need capital for plant and machinery or any sort of assets which bank understand, bank would be a good source of capital for that.
Interesting, interesting. And so, Abhiroop, for someone to be able to raise growth capital or revenue-based capital, right? Do they need to sort of have, be profitable, sort of, what kind of company they need to be, right, to be able to look at these options? Because then you have to pay back that capital as well,
Yeah.
across cycles.
Sure, sure. So see, I think we definitely like profitable companies because they are extremely capital efficient, and they are essentially raising capital not for their survival, but for driving the growth in the business, right? So definitely, I think profitable businesses are good, but that's not a hard constraint for us at Velocity. What we look for is we understand the unit economics of the business, and we build a point of view on the fact that are they really making money at a unit level or not. It is
Okay.
possible that they have some overheads, but as long as their contribution margin positive, we believe that with some growth, they can get to profitability. And we are happy to fund companies of that nature also, which may not be profitable today, but if they grow, then they will become profitable.
Got it. So then are you saying that, should companies focus on, building positive cash flows and then, look at, say, okay, break even and then profitability? That's how, is that the sort of way to build a sort of enduring, sustainable business? What's the best way to do that?
Well, it's actually different things for different types of businesses that can exist, right?
Yeah.
Uh, and I can take a few examples to explain that.
Sure.
I believe that in case you are building, let's say, a D2C or an e-commerce business, right?
Mhm.
Then the ideal approach, in my opinion, is to basically start in a bootstrap fashion. Ensure that you are making some experiments to figure out the right product for the customer, figure out the right marketing channel, figure out marketing efficiency. At
Mhm.
that phase, you can also raise some angel money. That is fine because that will allow you to make those experiments, give you some leeway on that. Once you
Mhm.
have figured out a playbook that this is my product, this is my segment, this is my marketing channel, this is my suppliers, etc., and
Yeah.
and you have figured out a good repeatable cycle for your business, then
Mhm.
revenue-based financing is a great way to accelerate that cycle. You can infuse capital into the business, you can pump that money into your marketing, into your inventory, etc., and you can rapidly grow the business. And then eventually you can take it to profitability, or you can raise equity capital also if you want, based
Mhm.
upon how you want to expand the business across multiple categories, right? But we have seen a lot of journeys like this happening in which people have followed this journey to great outcomes. And I think that's the ideal way, in my opinion, to build a D2C kind of a business. But in case, for example, you are building a different type of business, in case, for example, you are building a marketplace, or you're
Mhm.
building any business with network effects, right?
Yeah.
Then the implication is that you will need to invest heavily to build the network initially. You will not
Yeah.
really be able to like get to profitability in the near term, and that would require heavy investment upfront. So if you are building that kind of a business, then you will need large amount of capital that will give you the wherewithal to build like a good network initially, which will make your business enduring over time, right? So to talk about one example in that space, I think my
Mhm.
previous company Taskbob was a business like that, in which you
Okay.
were essentially building a network of households and the service providers. And
Yeah.
to build that network, you have to invest in both sides of the marketplace, which will require heavy upfront investment. And hence the company which is sort of breaken out of the I think 50 odd companies which got started in that space
Mhm.
is Urban Clap, which was like extremely aggressive with fundraise.
Yeah.
Within 1 or 2 years, they had raised like 25-30 million dollars, and that really allowed them to build a much bigger and denser network compared to anyone else.
Okay, interesting, Abhiroop. So, just taking a sort of a side turn here. So you mentioned about Taskbob or Urban Clap, both of these. So you're saying that sort of in these kind of markets, right? Is it just winner take all, right? The one which raises the largest round, ends up winning the market, or can you also be someone can also be like a capital efficient business in those kind of markets as well and still win the bet? What do you think about that? What's your take on network effects and high risk businesses like those?
Sure. So see, I think there are niches which can be carved out even in places like those, right? So for
Mm-hmm.
example, while Urban Clap or Taskbob were trying to build like a countrywide network in which
Yeah.
you sort of build the most efficient way for people to get these home services at home in a high quality, reliable, and time bound kind of a fashion. That is a scale game. So the bigger your network becomes, the denser it becomes at a hyper local level, the better the
Yeah.
customer experience keeps on getting, right? So that becomes very difficult to change.
Yeah.
But in case someone wants to build a business in that, it is
Mm-hmm.
still very much possible to build a profitable business.
Mm-hmm.
You can, for example, pick up a niche customer segment. You can, for example, pick up like HNIs in India, right? And then
Yeah.
you can build a focused home services based solution for them. And that can
Okay.
become a profitable business. You will differentiate on the quality, on the kind of customer experience, on the kind of, in case, for example, you're talking about a service like home cleaning, on the kind of cleaning products that you're using, the techniques being used, the way people are trained, etc. You can create
Mm-hmm.
differentiators like that. And for that niche, you can be a much better experience compared to urban craft.
Interesting. Yeah,
Yeah.
makes sense. And Abhiroop, so on Taskbob, right? You sort of 6-7 years back, you raised a large Series A round, right? 5-6
Yeah.
million. That was a
Correct.
pretty large sum back then. Today, maybe
Yeah.
it's a common, fairly
It's
common
a
thing
seed
now.
round today, I think.
Yes, yes, yes.
Yeah.
So, considering that you raised a large Series A, etc., right? And sort of, what were some of the mistakes and learnings that you had from Taskbob, and which
Yeah.
you would want to share with other founders as well, right? What they can avoid, and what you've also learned and applied at Velocity. We'd love to hear from those as well, your
No, absolutely,
experience.
Nitya. I think there are so many of them that I can write a book on it, which I think I'll write when I have some more time. But I think, so if I have to talk about the top three learnings, which, and I think all of them we are building upon as we build Velocity right now. I think
Yeah.
the first one is to not hire too quickly, especially if you are pre-product market fit.
Mm-hmm.
When you are pre-product market fit, then your entire focus should be to keep the team lean and to iterate rapidly to get to product market fit. Once you get there, then obviously you can try and ramp up your hiring, and that will drive growth. But in case you get too many people before product market fit phase, they don't
Mm-hmm.
really help you get to product market fit faster, right? So overhiring before product market fit is a mistake which needs to be avoided. And I think we have been extra cautious of that at Velocity. When we started, I think even though we have been pretty well capitalized since early days at Velocity also,
Yeah.
we have been a very lean team. And the entire team has been very hands-on. We have been very close to our customers. We have been taking feedback and iterating on the product rapidly. And now I think as we are post product market fit now we are at a phase where we are expanding the team rapidly. And I think that is actually going to help the business growth, right? So that is one. The second one, I think, which is a key learning for me, is that distribution is as important as product, if not more.
Mm-hmm.
At Taskbox, for example, we were extremely focused on building a high quality product, building a great customer experience, which is great, right? All the founders do that. But what we did not innovate enough on was on how to take that product to our customers, right? How to distribute it. If you basically rely on commoditized channels like Google and Facebook ads,
Mm-hmm.
then that would also become very competitive very quickly. And a player which has more capital, they will be able to muscle you out of that, right? So you need to build your own distribution channels. You need to ensure that you are, even if you have a great product but you don't have distribution, it is not a winning strategy. So that's very important. And I think third one is to also think about your investors as really long-term partners. And basically these are long-term relationships which are very difficult to get out of, right? So you
Yeah.
should evaluate investors also in the same way. Uh, Typically first time founders don't really do that. So investors obviously do a lot of diligence on a startup. I think founders should also do an equal amount of diligence on the investors, and build a point of view that is this really the partnership that you want to be in for the next 8 to 10 years or not, right? Because it's a irreversible call once you take it, right? And hence you
Yeah.
should be very sure of who you are taking on the cap table. It is even more important than the kind of valuation or the kind of amount of capital that you are raising. The kind of investors and your alignment is also equally, if not more important.
Interesting. I love the second one, Abhirup, where you're saying that you sort of try and innovate on the distribution channel and the sort of traction channels, right, which you want to go
Yeah,
after. Because if you're relying primarily on Facebook, Google, all these channels,
yeah,
the sort of largest funded competitor can beat you out, right? They can
exactly.
sort of pump in more money. So that's
Yeah,
pretty interesting that even with lesser capital, you can probably innovate there along with
exactly.
the product, and maybe still try win and sort of be maybe the sort of challenger as well. That's an
Correct.
interesting take.
Yeah,
And another thing, Abhiroop, is so as a sort of a founder as well as investor, you've seen multiple sides of the table, right? And we see this quite often that a lot of startups maybe running out of cash, having to shut down, etc. So is it because the running out of the cash the only reason why a lot of startups have to shut down, other than not having a product market fit? This post product market fit, right? You still run out of cash. Is it
yeah,
just because of that, or are there other mistakes also founder make often? Because
yeah.
a lot of times we've heard that running out of cash is one of the common sort of reasons. Are
Yeah.
there other reasons, or this is the only one? And if that is it, why do founders not try and avoid that? Any take on that?
Sure. So see, I think while I definitely agree that running out of cash is the biggest reason, and happy to talk more about like how we have thought about it also in the past. But there could be more reasons also. So, for example, I have seen startups shutting down because of co-founder issues. The co-founders don't really get along very well, right? Or because of like not getting to product market fit, as you mentioned. So there could be multiple reasons why a startup fails, but running out of cash is definitely one of the biggest ones. And I think so. I'll just go back to the fact that in my opinion, there are two ways to build a startup.
Yeah.
Uh, I think one way is what I call the go big or go home approach, in which you try to grow rapidly. You are going all in, and either you have a small odd of a big outcome, or you basically go bust. Right? That
Yeah.
is basically one way to play this game. The second way to play this game is to go big gradually without risking going home. Right? And in that approach, you can build like really long-term enduring businesses without really taking a lot of pressure of like short-term growth and all of that, right? Uh, Picking which game to play is a function of multiple things. It's a
Yeah.
function of the idea that you're working on. It's a function of your own ambition and your own preference. It's a function of the competitive intensity in the market that you're playing in, and it's also a function of whether a short-term growth can lead to like long-term competitive advantages or not, right? So it's about picking the right game to play. I would say that while it's not a good idea that for you are like trying to grow very fast and then you run out of cash and then you shut down. But what also may not work out is that you are operating in a very competitive market and you are like very slow to it. Other people are able to dominate it. And
Yeah.
hence, while you may not shut down the business, but you will end up with a business which is not as big as what you could have built if you're more aggressive, right? So, and basically taking that decision is hard, that which game to play. Do you want to play the go big or go home game, or do you want to build an enduring business gradually based upon multiple factors I talked about? That call is hard, and that's why I think people keep on like taking trying to balance between the two based upon capital availability also, and
Yeah.
that leads to the kind of outcomes that we see in the press.
Got it. And
Yeah,
Abhirup, so between both of these, right? While the go big, go home approach, right? Not every idea, every market business, might have that kind of outcome, right? Probably
yeah,
10-20%, you could sort of share your thoughts,
even
maybe
lesser, I
ten
would
twenty
say. Yeah,
percent
yeah,
of them. And rest
yeah,
of them, might be where you better off, raising a sort of a, a sustainable sort of, capital, you build
yeah.
long term, over decades probably, right? Most
Correct.
of those ideas. Is that the case? Or, you can have go big go approach in a lot of businesses? Is it sort of more like maybe 50-60% of those businesses can sort of grow too fast and dominate those markets, etc.?
No, yeah, I see. So I think that share is even lower than the 10-20% that you talked about, right? I think the share of businesses which are better suited for the go big or go home game
Mm-hmm.
would be less than a single percentage in my opinion. And I'll tell
Okay.
you why, right? Because see, I think in the entire universe of tech first companies also, all the e-commerce and D2C brands that we also track, that we also fund, VCs probably end up funding 1% of them. So already they apply a filter on which they believe can really become big, can become unicorns eventually, right? That
Yeah.
anyway is like 1% of the entire universe. And even in that 1% of the VC funded companies, the failure rate is very high. So a vast majority of even those companies will end up failing, and a few of them will really end up becoming like very large companies, right? So there is a big difference in what the reality is in terms of uh, what results can that game deliver versus what people perceive it to be, right?
Yeah.
And I think that's what leads to these calls going wrong quite often. So that's in a way the change that we are trying to bring in, Nitya. We really want to support people who are building a bootstrapped, capital efficient kind of a business, and which are keen to build like sustainable, enduring businesses, which can become profitable 100, 200, 500 crore companies, which may not become unicorns, but those are still great outcomes for the founders to build.
Absolutely. And those could probably take 5, 10 years, or maybe even decades, but you can get to that outcome rather than going bust, and like you're
Exactly.
saying, not every business sort of can be that, go big, go home. So you're rather better off, building for the second outcome, unless you are in a very sort of fast growing, a very exciting
Absolutely.
market, maybe
Yeah.
1% or less than that, right?
Yeah.
That's an interesting take.
Exactly.
So one more thing, Abhiroop, you mentioned previously is, at Taskbob, right? The kind of investors, you sort of raised, you associated with them for years and decades, right? While you're building that business. And
Yeah.
there was this, tweet that got viral sometime back where Anand Lunia, he mentions that, you should be very cautious of the color of capital that you're raising,
Yeah.
because
Yeah.
capital is right now abundant out there in the market, right? Um,
Absolutely.
so talking about that, right, how does that change the outcome, which is, the kind of investors you're raising from, are they aligned with you? How does that change the outcome for your startup? And second is, does capital, in fact, change the outcome of a startup in a positive, or can it also have a negative outcome as well, right? If you're raising too much capital and things like that. So what
Yeah.
sort of impact does raising capital have, and the kind of capital that you're raising, all of this, impact on the outcomes of your startup, positive, negative, both of them?
Absolutely. So I'll take both questions one by one. First is about the color of the money, and I did not really like think much about it in my previous startup, but I realized that that is actually true, and that is something that all the founders should care about. I would actually go to the extent of saying that even if the kind of valuation, the kind of capital, etc. is better in a particular term sheet, but you are not that strongly aligned with the investors, then you should go with something which is lower valuation, lower capital raise, etc. Also, right? Uh, and I've seen founders often make this mistake that they try to compare on the hard parameters which can be compared, which is like how much capital, what is the valuation, what is the dilution, and things like that. But
Yeah.
it is the softer things which matter a lot more. So I think a few things that people should look for when they take this call is that first
Yeah.
of all, as I mentioned, they should do a ref check. They should particularly talk to companies which did not work out in their portfolio, right? Because how they handled and how they behaved in those scenarios will tell you a lot about both the pros and cons of working with an investor like that, right?
Yeah.
I think second is that you should try to work with investors who are high conviction. There's a lot of hot money coming into the system, which is basically looking for short-term returns. But building a company is a hard long-term process, right? So you need to figure out that you are obviously operating and building a company with a high degree of conviction. Do the investors also share that conviction or not, or are they in it because it's a hot deal right now? Because when the times are bad, then they will also lose their conviction as quickly. If that is not the case, right? So that
Yeah.
becomes very important. Uh, and I think that is something that I have definitely learned. We are very fortunate to have Alar Ventures as the lead investors in the current company. And it was sort of a 8 to 9 month process over which they built their conviction, they understood the market, they built a point of view on us as a team also. And that really led to a very good alignment of what we are really trying to do in the long term, right? And I think that matters a lot. So that is there. What was the second question, Nitya?
Yeah. The second question was, does raising capital change your, outcome in a either a positive or negative way? Does it have an impact on the outcome as well, right? Raising
Yeah.
capital, too much capital, the size of round, dilution, all of
Correct.
this.
Yeah, absolutely. So I think the answer is yes. So I think the pro of raising a capital, and I did speak with a bunch of people who were bootstrapped earlier and who then raised equity capital, and I was trying to understand from them that what has really changed for them after the equity round, right?
Yeah.
And I think one thing which everyone talks about is that it gives them the leeway to not really worry about short-term survival, but
Yeah.
take like the right medium to long-term decisions, right? Uh, if you don't really have equity capital, then you are operating on a very small buffer, and hence you are constantly trying to solve for like the monthly payroll and all of that, right?
Yeah.
If you have some leeway, you get some buffer, and hence you can afford to take the right calls in the medium to long term. In that sense, I think raising some capital is good. But at the same time, the counter of that is also bad. Excess of everything is bad, including capital, because big capital will come with big expectations, and the if you are like trying to raise too much money too early, then it will come with expectations on growth, on the size of the outcome, etc. And hence, you might not really get the kind of leeway you had earlier to make mistakes, to be iterative, and to have that gradual discovery process going, right? So that's the counter side of it. That if you raise too much capital, you will be like running uh, at the top speed. You will have like high expectations to meet, and you may not really get multiple shots at making the mistake and learning from it.
Got it. Got it. And Abhirup, you mentioned that, with Valar Ventures, it was like a 8-9 month process, right? That's a long process.
Yeah.
Probably some businesses or startups, they don't have that sort of, time on their side as well, right? Because they need to sort of raise a round and, move to the next stage, etc.
Sure.
Sort of probably you had that benefit, right? Sort of your time on your side. Do sort of all startups, can they optimize for that, right? Or, should they then sort of optimize for time versus the kind of, investors they're bringing on board?
Sure. So the 8-9 month process that I'm talking about, Nitya, it involved capital commitments across multiple phases. So see,
Okay.
across every round, Valar was the fastest to move. Whenever we discussed fundraise, they were like immediate to react.
Okay.
But they started with a very small position initially. They had initially participated in a seed round, which was a very small round, and they had only taken a tracking position in that. Then when we raised the next round, they doubled down on that. And then more recently, in November last month, when we raised a 20 million round, it was again led by Vala, right? So it was basically a small tracking position which kept on improving. And I think that's a good way because the investor also keeps on increasing the conviction that they have. Uh, that said, I think founders should definitely, founders definitely value investors who can move fast, right?
Yeah.
Uh, and I think that leads to that kind of a dichotomy that, is the investor moving fast because they just want to get in or because they're coming in with a high degree of conviction? And I think the work required on the investor side, which is also a role that I have played, is
Yeah.
that even before the deal happens, you need to be ready with your answer, right? You need to be clear of the market, you need to be clear of the opportunity, you need to be tracking a bunch of teams, you need to be able to
Yeah.
move very quickly when the right deal arises. And basically, that's what leads to a combination of being high conviction as well as being fast. Uh,
Interesting. And one more thing that you mentioned, Abhirup, was, one of the reasons sometimes startups shut down is because of co-founder issues, etc. Right? How
yeah.
did you find your set of co-founders when you were starting Velocity,
Yeah.
right? And sort of how can founders avoid those kind of mistakes as well? Because those are
Sure.
probably not the best ones, right? You can have other reasons, but that's not the one you would want to have.
Hi, but it's far too common. I think, every month I hear a few cases of uh, teams not working out because of co-founder conflicts. And I think the learning or the reason for that is that even being a co-founder is a long-term relationship, right? And
Yeah.
you don't get into a relationship blindly, right? So I strongly believe that when you start a company, it's highly likely that you already know your co-founder. Your co-founder should ideally come from your existing networks. They should be people that you trust. They should be people who you have worked with, and all of you should have a very good equation working with each other. You should know the good side as well as the bad side of the person you're working with, and that becomes very important to be doubly sure of, right? And I think for that reason, co-founder dating platforms are not really taken off, right? Because it's not a blind date which can be arranged and then you basically end up starting a company together. You typically should start a company with people who you have a high degree of trust and comfort with,
Mhm.
and ideally people who have a strong history of working together with a very good working equation.
Mhm.
Across both the companies that I started, at least that was the case. I had started Taskbob with a close friend from college, who is Asim Khare. And we had been very close friends. We had worked on multiple projects together, and then we had been in touch even after college. Even at Velocity right now, both of my co-founders, Atul and Saurav,
Mhm.
they were part of the top team at Taskbob.
Oh.
So at Taskbob, Atul was heading operations, Saurav was heading technology. And building a startup is like going on a war, right? So you've been through ups and downs of the entire journey of building a startup, and that leads to a very good working equation. So that was a great starting point for me in the company right now.
Interesting. So basically, you're saying that building a company is sort of, years and decades, right? So you choose the people you want to work with, your co-founders, the core team, and the investors, all of them who are sort of aligned with you for that, the long term.
Yeah,
Because in between, if there are, some issues, it might lead to bad outcomes or, not good things probably.
absolutely. So I think having that long term mindset is very important. We should not approach building a startup with a 2 or 3 year kind of a mindset. You should think at least a decade, if not more, right? And all of your key decisions across picking the right co-founders, picking the right investors, should be governed with that long-term mindset. That do you really see yourself working with these guys over the next decade or not, right?
Yes, yeah, yeah. And right now, so even in the current market, Abhiru, there is probably some abundance of capital, even say for D2C startups and brands, right? You were saying, you can build different companies and outcomes in D2C, but we still see, D2C startups raising a lot of equity capital. Is that something which is advisable? You said you work with 300, more than 300 companies, D2C
Yeah.
especially, right?
Yeah.
What's your sort of thoughts on those?
Yeah. So, see, I think the biggest thing that venture capital has done well, in my opinion,
Mm-hmm.
over the course of the multiple decades of VC as an asset class existing, is
Yeah.
that they have built a very strong hype and narrative around it, right? It is it is cool and sexy to raise venture capital. And I think that's the change that we are trying to bring in. We are trying to educate the market in saying that, while it's good to have some venture capital, some buffer, but it's also a very expensive source for you, which comes in with a lot of expectations, which also comes in with you giving away control of the company that you're trying to build, right? So I have had multiple discussions with the founders that we work with about this. And
Mm-hmm.
in the right context, I also proactively help them to raise venture capital. I actively connect them with the VCs that I know of, right? But I think it's important to understand that venture capital is not free. It comes with you giving away the most prized asset that you're building, which is the value of your equity. Uh, and I think because there is no short-term repayment, people assume that this is something which is good, but it is actually much more expensive in the long term, which more and more people are over time realizing. In that sense, I believe that, as I mentioned earlier, you could raise equity capital based upon the business you are building, based upon the kind of risk and the uncertainty of the outcomes that you're going after. But across the vast majority of use cases, particularly in the D2C and e-commerce space, right, close to 70% of the spends of a D2C or e-commerce business is across marketing plus working capital, right?
Yeah.
And I think that 70% should not be funded by equity capital. It should be funded by capital which is like much more friendly, in which you're not giving away control, in which you get to govern the way you want to grow the business yourself, right? Uh, and that's what we're trying to build at Velocity, Nitya, honestly. Yeah.
Interesting. And you mentioned you work with sort of 300 and more sort of companies and brands, right? So
Yeah.
in experience working with some of these, right? At what stage they might be or time would be right for them to maybe look at a growth financing, revenue based financing, or
Yeah.
a external equity round, maybe a venture round, etc. Right? At what
Sure.
stage scale, maybe in terms of revenue, product market fit, some of these specifically from a
Sure.
D2C perspective, because non D2C, right, you're building for a large outcome, network
Yeah.
effects, etc. Those
Correct.
things are
Exactly.
pretty clear. But for a D2C space, how do you think about this? What's the experience you've seen working with these multiple brands?
Sure. So, see, I think most D2C businesses should not end up raising equity capital, in my opinion. And I think that's a controversial opinion. That's an unpopular opinion, I'm sure. But I have reasons to believe that because, see, I think it's not going to be a good outcome for both the founder as well as the VC if you like raise too much equity, right? Because if you raise too much equity, you are constantly trying to build a very large outcome, which may or may not happen, right? As I mentioned earlier, it is like less than 1% of the cases which are best suited for equity capital, right? But vast majority of the people should therefore focus on building a great, enduring, long-term business, which can be a 100, 200, 300 crore business. It's immense opportunity in India right now to build like a direct-to-consumer business right now. But raising equity might not be setting you up for success in that game. I believe that the right stage for you to consider raising some equity, which could be an angel or a friends and family round, is basically when you get started because you need some capital to get started. And At that early stage, basically, angel capital can help you build like the right product, figure out the right market, and all of that. But
Yeah.
once you have built a good product which is gaining some traction, once you have at least 6 months of history that we look for, right? Uh, at Velocity, we look for at least 6 months of revenue history based upon which we can try and understand what the going forward scenario is going to be for your business.
Mm-hmm.
Then you can just use revenue-based financing to accelerate the business. It's a it's a very convenient and fast source of capital for you, in which you don't really have to dilute your equity and give away the control of the business, while having the complete flexibility of paying it back as a share of your revenues, right?
Got it. And another thing that you mentioned was, there's no reason for you to sort of raise capital for your, inventory, OPEX, OPEX, as well as, marketing from equity, right? You can rather raise debt or, revenue-based finance. And in that as well, right? So when you sort of raising revenue-based finance or, equity, how do you deploy that well as well? Like what places you can deploy, whether it's equity, where you should deploy equity rightly, and, where you should deploy revenue-based financing, and how
Sure.
much you should deploy as well, what percentage of your revenues or finance that you've raised, so that you're not over deploying and you're sort of sort of spreading too thin as well, right, in those cases.
Sure. Sure. So see, I think particularly if I talk about the context of D2C and e-commerce brands, which is the segment that we exclusively focus on, then it's important to maintain the capital efficiency of the business, in my opinion, because it should not be the case that the market turns, the equity capital dries up in the market, and then you have sort of bloated up your cost base and you're dependent upon the funding happening, because then you will be left high and dry, right? So it is therefore important to increase your costs gradually and to use a disciplined way of capital, which is revenue-based financing, to fund your day-to-day working capital spends. So I think in terms of the typical spends of an e-commerce business or a D2C business, if you're working on like R&D, product development, if you're working on building some technology platform, etc.,
Mhm.
equity capital might be a good source of funding for that, because you are not sure of the outcomes, you're taking some risk, etc. Uh, and you may not expect any payback in the short term, right? But for the core of your business, which is basically the marketing, which is working capital, uh, that is a more predictable part of your business, because you know that for every dollar that you're spending in marketing, you could be generating 2.5 to $3 of returns, right? Uh, and for every dollar which is being spent in inventory, based upon your gross margin, you could be generating $2 of revenue. So if you have that prediction cycle established clearly, then
Mhm.
it makes a lot more sense to use revenue-based financing for that. And hence, I believe that close to 60-70% of the business spends should be funded through revenue-based financing. Only when you are making some experiments which are more long-term in nature, which can potentially lead to disproportionate returns, but which may not have any short-term payback, those are the spends that you should try and leverage equity capital for.
Got it. And in terms of your say marketing spends as well, right? Sometimes we see businesses spending a little more on marketing. So what percentage of your monthly or annual revenue you should be spending? If you're a D2C brand, you should be spending on marketing. And
Sure.
basically your experience working with these brands, or what's your take on that, right? So that you,
Sure.
because currently we also hear that the ad spends, the CAC, all of those are rising too fast. So
Absolutely.
then you need to balance between your growth as well as spending too much, right? So where do you draw
Yeah.
that line? What percentage of your revenue is it okay to be spending on sort of ads and acquisition, etc.?
Sure. So, see, it's a function of the stage of the company and it's a function of the sector that you're working in. So,
Mhm.
it's a grid like that. I think when you're early, then obviously you will have to do some experiments. At that time, your revenue itself is going to be slow. And hence, even if you are keeping some experiment budget, your marketing spend as a share of your revenue is going to be high. Uh, and I think that is okay, because you will have some leeway that, at least for the next 6 months or 9 months, I will be basically trying multiple things and then trying to build a predictable cycle here. After you're past that phase,
Mhm.
then what is the right percentage of revenues in your category, that becomes important. And I think we like to think it as a function of the gross margins of your category, right? Because finally, I think the objective of a D2C business should be to become contribution margin positive. So in categories which are high gross margins, which are category like health supplements, personal care, cosmetics, and to a good extent apparels also, you can sort of operate with ROAS of 2x also, 2.5x also, and those are good ROAS. But in low gross margin categories, which are like food and beverages and then
Mhm.
consumer electronics, etc., there your ROAS better be good,
Yeah.
because anyway, if you are making like a 30% gross margin, then that should be the upper cap of what you potentially can spend on your marketing, right? Because you finally have to be contribution margin positive. And hence, I believe that the right amount of marketing spend as a share of revenue should be driven by the sector that you're operating in and the gross margins of your product, therefore.
Got it. Yeah, that does make sense, right? How much sort of what space you're operating and what's the competition like, as well as what sort of gross margins that you have. uh,
Sure.
And just a follow-on question on this, right? You mentioned about a bunch of these things and metrics. So, at what stage of the business, should a D2C brand focus on, say, being contribution margin positive, being, say, cash flow positive, being profitable, and breaking even as well, right? So say maybe you're starting off today, at what stage scale you should start thinking about this, so that you're building sort of a long-term business, and focus on those as well, and you're not sort of burning too much as well, right? Not having a
Sure.
contribution margin, maybe first year or first 6 months, is it okay to have a negative contribution margin,
Yeah.
as you grow, right? How that changes.
So yeah, initially when you get started, your initial period will be negative contribution margin because you don't really have things figured out, right? So, and that is okay because you do need that time to like figure out the right marketing mix, the right products, the right suppliers, and all of that, right? All of these evolve initially, right? But I think the first goal for the business should be to build a product which is creating a pull, right? So you should not worry too much about uh, getting to profitability earlier, but you should have a product which is a differentiated product which comes in with a unique story and which is like creating a pull from the customer. So that should be the first focus. Once you have that, then I think the focus should be on rapidly growing that business. Uh, and as you basically grow that business, you will need the capital for your marketing as well as inventory needs, which is what we fund. Uh, After that growth period, I think eventually the goal of every business is to get to profitability. But in case you are building a business which you want to be a large business, I think that should be the cycle. That initially the first period should be to the north star for that period should be customer satisfaction, should be the fact that people absolutely love your product. If you have that, if your margins are broadly making sense, you then accelerate the business using revenue based financing to try and grow your top line. And eventually, based upon the size of the outcome that you believe is possible in your category, you try to move towards profitability.
Got it. And with regard to, say, being CM positive, right? What stage is it okay? First year, first 6 months to be sort of negative, and then start
I
building
think
up a
so.
positive contribution margin, or from day one
Yeah.
you should focus on, maybe, or if you sort of want to focus on growth, maybe second or third year you start thinking about this. When
Hmm.
is it? When is the right time, or there's no sort of right answer? Does it depend on the kind of business and category, etc.?
So I think you should try to be positive contribution margin because before you like push the pedal on growth, right?
Mm-hmm.
So in that initial 6 months to 1 year broadly, I think the focus should be to try and figure out the right marketing structure also, because that's what is going to make your business sustainable, right? If you are not contribution margin positive, then with growth you are losing more and more money increasingly, right? But if you are contribution margin positive, then basically growth will tilt the equation in the right direction for you. So I think in that initial 6 months to 1 year, you should focus on building a great product and also figuring out how to get to contribution margin positive. Then you should push the pedal on growth, uh, and then that's what will take your business to profitability eventually.
Makes sense. So you're saying, first 6 to 12 months, you focus on building the right product, customer satisfaction, etc., as well as figuring out the right marketing channels, positive contribution margin, what's the
Exactly.
ad, marketing spends and the other spends you
Yeah.
can afford to do. Once you do
Yeah.
that, you probably raise some equity capital, some, revenue financing, revenue
Yeah.
based financing, etc., and then you push the pedal. Because if you are CM
Absolutely.
negative, right, you sort of accelerating in the wrong direction, which is not where you would want
Yeah.
to go. You rather figure
Absolutely.
that out, take some more time, and then start sort of pushing the pedal.
Absolutely. But so, uh, I just like to change one comment there that I don't think it is right to put a timeline to it, right? Because I think it's possible that some businesses get there in 6 months, and it's
Yeah,
perfectly fine for some businesses to take 2.5 years also to get there. But I think taking the right decision at that point becomes important. That whenever you get there, it's only after that that you should start accelerating the business rapidly. Until that time, you should keep things very lean and you should be more iterative in your nature.
okay. So you're saying basically, founders should have a little more patience, not put a lot of pressure of time, say 6 months,
Yeah,
12 months when they're starting off. Take
exactly.
a little more time, sort of build out that
Absolutely.
product, customer satisfaction, positive contribution
Yeah,
margin, and then think about growing, accelerating, etc. Right? And not
absolutely.
because at this stage, right, like, a lot of competition, other founders, you want to look at them, sort of think that, okay, let's try and sort of build it a little faster because you don't want to miss
Yeah,
out on the market, etc. But I think then you're saying the
absolutely.
best way is to focus on your business, your metrics, and then accordingly
Absolutely.
think about growing, accelerating, especially, say, in a D2C space where it's not winner take all, right? You can,
Absolutely.
maybe there can, saying there can be multiple brands in a category as
Yeah,
well, right? Are
absolutely.
you
Yeah,
saying?
absolutely. we at Velocity strongly believe that there will be thousands of brands in India, right? India is anyway a brand starved market, and there are so many niches emerging. There is a big platform shift which is happening of people spending more time online, and there will be lots and lots of new brands which will emerge. And we are building Velocity primarily to power the growth of all of these brands.
Interesting. And then are you also seeing, in this case, multiple brands sort of operating in similar spaces, or then do they also try and carve out niches to stand out in that market? How are that like? Because you're saying there can be multiple brands in
Yeah,
categories.
yeah,
Well, how
yeah.
are you seeing that pan out?
So I think the way to build any business, and I would actually go to the extent of saying that it's not just about D2C, but it's about building any business, is that you start with a very niche and focused segment, right? That, this is the very specifically defined customer that I'm building for. And I think that is true for D2C also, that when you get started, you have to be very clear of which is the specific customer segment for which your brand is going to appeal a lot more compared to anything else, right? And I think that's your entry point. You initially focus just on building a distinctive value prop for that segment, and at least for that segment, you are the best choice for that customer, right? After you have that sorted, as a segment grows, you will automatically grow with that. But then you can also consider expanding across multiple dimensions. So for the same segment, you can build more products in your portfolio, or you can sort of get into adjacent segments also. But those opportunities really open up for you when you have done a good job at building a great product for a very well-defined segment initially.
Got it. Interesting. So you're saying basically, focus on a niche and, sort of you build the best product, go-to product for them, and not sort of compete across segments. You build the best product for a particular segment, you focus and, sort of
Yeah,
you the sort of number one, number two brand over there. And then you sort of
exactly.
start looking at other segments or, sort of other target groups, etc. That does make sense.
Absolutely.
Rather than just
Yeah.
going all in, sort of targeting
Yeah.
across segment, because then you're not the sort of number one, number two brand as well for those, right?
Correct.
Makes sense.
So, actually, one more point on that one, that, while that, in my opinion, and I have a very strong opinion on this, that, this is the right way to build an enduring business, is to start small, focus, and build a 10x better product for that segment.
No?
More often than not, a story like this will not fly in a VC pitch, because VCs will talk about the market size of that segment, and hence they'll say, yeah, this is not really a big segment that you're going after, and then potentially you will not become a very large business. Uh, and that can happen. But I think even if you aspire to build a large business, right? If you start with a very big market on day one,
Mhm.
then you will be lost. That, who are you really building for? What is the product? What is the problem? Because there's so much noise in a big market. But when you define it clearly, then you are able to build a much better experience for that segment to start with.
Interesting. And that's why probably, stories like Mama also come in, right? Where they started as a niche brand and today sort of they're a very large, VC funded brand.
Absolutely.
Do you see
Yeah.
those kind of stories also happening then, where you start with a niche, but you have sort of you crack the product and distribution so well that, your
Yeah.
market automatically expands and you become maybe like a VC fundable business or large outcome as well. Those stories can those also happen in D2C? Like
They
many
will
more
certainly
like those.
happen, Nitya, in my opinion. So see, I think VCs get the total addressable market size wrong all the time, right? Uh, and I think that's also very difficult to sort of project and predict what the TAM for a particular market is going to be.
Yeah.
And internally, in our leadership team, also we joke about that there is only one limiting factor to the TAM of a company,
Mhm.
which is the ambition of the founder. I mean, if you want to build a large business, then eventually there are multiple axes on which you will expand, right? So it's wrong to like only talk about the current product and the current market and try
Mhm.
and estimate time based upon that. But if the founder and the team is really ambitious and they have a way, they have an approach in which they can build a predictable way to grow the market, it can potentially be a very large time. And I think, as you mentioned, Mamaearth is a great example in that sense. That initially, when they started, they had a very clear, well-defined niche, and they had a very clear positioning of better quality products for moms and babies.
Yeah.
But I think that led to a great early adoption. That led to their brand being built. That led to people like talking about it actively and all of that, right? Uh, that's what leads to distribution. And basically, once you have distribution, you can add more products and keep on growing the revenues of the business.
Absolutely.
Yeah.
No, that's an interesting take, Abhirup, which you said, right? Like, it's only the hunger and the hunger of the team and the founders that, the outcomes can be. You can start with a small market and TAM and then, keep going into adjacent markets and, keep
Yeah.
expanding. other than that,
Yeah.
we've also seen that house of brands approach as well, right? You start with a brand and a niche, and then you open up another market segment, another niche, and sort of you build a house of brands as well, right? We've seen
Yeah.
startups and founders doing that as well these days. So
Yeah.
yeah, that's a very interesting one.
And in fact, I think it's easier to think about these things in retrospect than to think about what will happen going forward. But if you think about every large business today, right, which is companies like Airbnb, Uber, Shopify, all of these companies, when they started in markets which were extremely small. And I think it would have been very easy for a venture capitalist to say that, these are markets which are going to be very small markets. What are you really doing in that market? But because they focused on a niche, because they built a great product for that, market also expanded, and then they also expanded into adjacent markets. And, and I think that's what led to the great outcomes that we see there.
Makes sense. And just one last question, Abhiroop, before we throw it open for the audience questions, is so if we look at the D2C space in US, right, and the West, we've seen some brands like Casper and Allbirds, etc., which have been sort of the VC darlings, and then today where they are, it's probably not the best position.
Yeah.
So what's your thoughts on take on what has been happening in the D2C space in US? And do you see that happening in India as well, or in India, brands and founders are much more cautious? Outcomes will be different here.
Yeah. So I think the miscalculation in a few of those examples that you mentioned, Nitya, was that VC started expecting typical tech venture capital kind of returns in the D2C market, and that is extremely rare in my opinion to sort of achieve that, right? And I think that's what leads to overcapitalization of the companies. That's what leads to the companies also ramping up their cost base, not being capital efficient, and then finally having outcomes which are not great for anyone. There is a use case for venture capital in the D2C space,
Mhm.
but I think VCs also should not expect uh, them to become like a $200 billion business or $100 billion business. I think there can be sizable businesses created. VCs can put in like a few $1,000,000, expect like 10x out of that over a time frame.
Mhm.
But that expectation need to be set that way, right? That this is the kind of profile of this business, and in a VC portfolio also you can have a mix, right? You can have a few moonshots,
Yeah,
which will potentially become unicorns,
yeah,
and you will have a few companies which don't really have that high a chance of failure if the team is executing well, but they will also not become 100x probably. They will become 8x or 10x, which is also good, right? So I think that expectation needs to be set very clearly, uh, and I think the market is maturing based upon the learnings globally, right? So I think while there is interest in this space because a lot of brands are getting started by great people, and uh, uh, and a lot of brands are going to get created in India, I strongly believe that a vast majority of these brands will become like good 100, 200 crore businesses, but may not become the kind of returns that we see expect right now out of the tech investments that they make.
got it. Yeah. So we'll throw it up for questions, Abhiroop. Just so there are a couple of questions. I'll just summarize them quickly, for you to answer. Is
Sure.
so those are around, say, RBF and velocity, etc. How does that work out? And sort
Sure.
of what's the process like? People were little curious on that also.
Sure. So I'll take an example to describe what velocity does, right? So I think we do a new kind of way to fund your business, which is called revenue-based financing.
Mm-hmm.
The unique innovation here is that instead of paying us back as a fixed EMI, which banks typically come with, you will agree on a revenue share, and hence, in case your top line dips, you will automatically end up paying us back lower in that month. In case the business grows, then also you have to bear the fixed share of the revenue that we have agreed upon, right? So a typical offer that we make would include three things. It will include the amount of capital that we provide. It will
Mm-hmm.
include the fixed fee that we charge on that, and it will include a revenue share that is the modality through which you will basically repay us, right? So, if for example we fund you 1 crore of capital, we could be charging a fixed fee of let's say 6% on that,
Mm-hmm.
and let's say we agree on a revenue share of 10%. Then basically what that means is that you will keep on sharing 10% of your revenue until the time you have paid us back 1 crore 6 lakhs if you have deployed 1 crore initially. So
Yeah.
we end up making at 6 lakhs on the transaction, and basically that is the revenue model that we have. But through this process, people can raise this capital upfront, and people can deploy that money into their marketing or working capital needs. To
Mm-hmm.
talk about how the process works, it's a very straightforward and seamless online process. We are primarily taking a decision based upon the digital data that you have, which is, I think, a great asset for online businesses. We plug into the online data sources that you have, and we build a transparent point of view on your revenues, the stability of the revenues, the cyclicity of the business, and things like that. And based upon that, we finalize the offer. It basically starts with a quick online form, based upon which you will get a term sheet instantly. That term sheet will define the amount of capital, the fixed fee, and the revenue share that you will be bearing. And then, after a quick diligence process, within 4 to 5 days, we are able to finalize the offer, and then we can proceed for a deployment after that. So all that people need to do is that they need to go to velocity.in, and they can begin the application process from there.
Got it. And what kind of brands, or what stage are they able to raise sort of RBF? Right, what's the right
Sure.
maturity or stage for them?
Sure. So we look for at least 10 lakhs of monthly revenue. Uh, so that's the starting point. Because we believe that before that stage, people are still sort of figuring out their marketing cycles, figuring out their inventory cycles, etc. But there is no upper limit. So we do work with brands which are doing 8 to 10 crores of monthly revenue also. So it's a fairly wide zone. And we need at least 6 months of your prior revenue data to build a point of view on the stability of revenue and things like that. So if you have a 6 month of revenue history with an average revenue of 10 lakhs per month also, then we will be very glad to initiate the process for you and then take it to closure very quickly.
Understood. Thank you. Thank you so much, Abhiroop, for taking out time. I'll just quickly summarize the session, right? Where you talked about, the kind of capital you should be raising, when and why you should raise, or not, why not you should raise it, depending on whether you're building a large outcome, like a go big or a go home outcome, or, probably a long-term sustainable business where alternative options like, raising lesser equity, RBF, all of these can become sort of helpful. And
Yeah,
especially in a D2C kind of a space where you don't necessarily need to think about, say, building a unicorn from day one, right? You start with
correct.
a small niche and build a strong sort of product for them, and then you start expanding the
And then
market
start.
TAM, etc., and
Absolutely.
then see whether you're probably able to achieve a very large outcome like a unicorn, or maybe like 100 crore, 500 crore business as well, right?
Yeah, absolutely.
Yeah.
That's a great summary, Nitya.
Thank you. Thanks so much, Abhiroop, for taking out time. We enjoyed the conversation. Thank you so much.
Absolutely. Thanks a lot for having me, Nitya. Pleasure to be here.
Yeah. Bye bye. Have a good day.
Bye. Take care.
Yeah.